clicked on this video because you want to learn how to buy a house with a business credit card at 0% interest. I'm not a financial analyst. I'm not someone that's a financial freaking planner. So this is simply just stuff that I've done. I'm not saying you should go and do this and that you need to do this. So let's get straight into it. Traditional financing pros and cons. You need to have a bit of a context in regards to everything we're going to talk about. So when it comes to Section 8, you rarely want to do conventional or FHA financing. The reason why is because it shows up on your credit report. Yes, you can put less money down, but you need more documentation. So it's harder for you to manipulate the financing in terms of using 0% interest business credit and other terms like that. So let's get straight into it. FHA, obviously everybody knows you can put 3.5% down. You could get in with low down payments, which if you're buying a $100,000 house over there in Cleveland, you can go and put $3,500 down, which really ain't anything. But in reality, you don't want that on your credit report. You don't want to have all the documentation. And you also don't want to be in a position where you need you need to pass a lot of restrictions. Conventional, same thing. You put 3 to 5 to 20, whatever it is, right? But it still shows on your credit report. But it's also manipulated it's also required to have, a solid debt to income ratio. So what this all means is simply that you're in a position where you need to have proof of income, which most people do not have, or they don't have it for enough years, like myself, because I was buying these rentals when I was, I turned 20 years old, and I was in the process when I was 19. So what do we want to do? You want to go with the DSCR or seller financing, right? These show up on your credit report, so it's hard to scale because it impacts your debt to income, how much money you make, how much money you spend. So if you have 10 of them, it's going to say, hey, look, you have so many damn houses and you make unless you start making 10 times as much money, then, you're still responsible for this. So you're less reliable and they're less confident lending out to you to buy another rental. So let's get into the next part when I talk about DSCR or seller financing when it comes to buying this house, because these are the traditional ones everybody uses when it comes to buying their own house. When it comes to rental, Section 8, you kind of want to either avoid them or, have the goal to refinance out, or you're only doing it just because you need to. So let's get straight into the next part. Let's see. The financing terms we use and how to manipulate them. So a lot of people do not really understand or at least grasp the idea of, let me put this right here so I could, like, what seller financing or what DSCR financing is, right? So DSCR loans. So this needs no W-2s. So if you're a business owner, this is helpful for you. No tax returns. If you don't file taxes, you can still do this. No 10 or 1099s. I don't know why I put of or 1099s, which is like if you're working as a real estate salesperson, and just proof of liquidity, which could just be manipulated, and that's what you're here for, right? So you just have to have this understanding of this context. So you can be in a position where everything makes sense. So what are the restrictions, right? It's decent credit, no credit to no credit, right? So if you have really good credit, they'll be relying on that. It's a very dynamic situation because the seller is in control of everything. So you want to be in a position where you're chilling no matter what. You can have lower down payments. You can put like 5% down, 10% down, just like the conventional, but you receive the benefits of having it, not be on your credit report, or be in a position where, like I said, you could be, still making the same amount of money, but you're putting less money down. So you can also avoid the W-2s, tax returns, all the above, these restrictions that make it a lot harder to buy, especially when you're buying out of state. You want to be as swiftly, as smoothly as possible. Seller financing essentially just means that you are receiving the house and you're giving a down payment to the seller, and the seller is receiving that as cash in their bank, but they still have the note of the mortgage. You're just making payments to the seller, seller's paying the bank. There's cons of this, like the possibility that the seller doesn't make the payments to the bank and then the bank just defaults. So let's get straight to the next part. This is what we primarily use. You need to make sure that you are using these or the seller financing if you're trying to do the manipulation. It's a lot harder with the FHA because they check 12 months worth of bank statements and a lot more stuff in comparison to these. So what does this mean? Debt service coverage ratio, DSCR, which I keep mentioning. Basically, just means if the property is going to be profitable, right? If you rented it out, because it's reliant on the cash flow of the house. So if the property has a mortgage of $800 and you're making $1,000 on it, and you're only profiting $200, that's still considered very good enough for you to qualify for it. So they just check off, the how much the property would rent for based off of other houses in that area. What's good about this is it only needs 2 to 3 months worth of bank statements, and if you're using business credit, your 0% interest period is only 12 months. So you want to make sure that you're getting as much 0% interest period out of the card as possible. 660 FICO with 3 accounts, prior rental experience, or 21 age regulation in some places, right? There's some ways you can get around it. There's ways to work around. If you DM me, I'll help you out. But that is it. Not W-2s, tax returns, perfect credit, debt to income ratio, 12 months worth of bank statements, just these things that I'm listing. So where does business credit come into play? How we manipulate them, right? This is what I've personally done. This is the reason why I'm explaining in the first place. There's a fast way, there's a faster way. the number one way that I recommend, unless you're in a position where you're struggling a little bit more, is have money already in your account, right? That you've built from doing your business, doing your side hustles, doing your actual job career, and using that money to qualify for the DSCR loan or for seller financing if you already are trying to like get a deal on the contract. So they see that you already have the money and proof of liquidity, right? So when they have that proof, you qualify and then you're good. You're in the clear because now you have the period of escrow, which you could go and manipulate with 0% interest business credit in the right way because you don't want to get in trouble. So the reason why I mentioned this is because one, it doesn't show up on your credit report as debt. All this utilization of the card does not show up as debt. Alongside that, you could keep more cash on hand. You have 0% interest for 12 to 24 months if you go and just get new cards, liquidate them, and pay off the old one. And if you're in a position where you want to do multiple things at once, but you don't want to use all your cash, you could easily do this if you know that you're going to make more money down the road, or you could just put profits towards paying down this balance. There's so many different ways that you could approach this, but it allows you to move a lot faster. You want to do it incrementally and not incorrectly. So if you've never received deposits, right, of over $2,500 in your bank account, you never want to just go and just OPM, right, which other people's money, aka the bank. You never want to go OPM 10 racks because you've never received that much, and also your payment processor has never been processing that much. So either one, the payment processor will get flagged. Two, your money will get frozen in the payment processor. Or three, it will clear, but it will get flagged in the bank account. So don't open a brand new bank account and then OPM like this, or open a brand new Stripe and do this. You'll have to season it by taking $500 here, $1,000 here, $600 here, $2,500 here, $3,000 for like maybe 3 months, 6 months. If you already have a business, this is great. You could just use this one and then just transfer it over with Zelle or Wire, whatever the hell you want to do. Do not, like I said, OPM large amounts because underwriters, aka people that make the final decisions, will try to flag you. But if you do it incrementally, that is in a way that's similar to what you do for work, it'll be fine. Like if you get paid every 2 weeks or every week, or you have your own business, you get high ticket payments, every other day, then you're in a better position. But if you're working, minimum wage, you don't want to just go and deposit this right there. You want to do the second way, which is what I'm gonna mention after this. So make sure you do it incrementally. Make sure that you season your Stripe account, your bank account, and you're not just going and depositing 10 racks overnight. Lenders will qualify you off of existing, but you want to use new. So business credit is 0% interest, 12 months. You can get more months by using the method I mentioned by just, getting another card, liquidating it, paying out down one. Now you have 12 months again because the balance goes on here. It doesn't show up on credit report. Keep more cash on hand. Get more, use of the cash that you have in your pocket because you use business credit, use other people's money to finance this house alongside the bank coverage. So the bank's basically buying the house for you, and allows you to scale relatively quickly because, like I said, cash is on hand, but it's not for everybody. You see how I'm doing this incrementally? 4,500 deposits. That's a little bit more typically that's a little bit around the range of what I would typically get from a high ticket program that I do offer. This is what I was doing on the 30th. Like I said, this is literally what I do. Like I do this. The way that you do this is just getting your buddy that has a business as well to send you an invoice for a certain amount. They pay it. You pay it with the business credit card. They send you the money back, and now it's cash in your account. You have the balance that you owe 1% of what you borrow. And also that person does not pay tax on it because it's considered a refund. This is what I use. Like I said, we financed this house. I didn't want to use all the cash on hand. So I really only came out of pocket like $9,000 of my own cash. Like I said, it's like $8,000 right here. $27,000 house. So really only 50-50 with OPM. And now we have multiple rentals because of this. So something that I said I've done myself, and I'm not just throwing out there in terms of theoretical, but it could be done. The other option is just starting earlier, liquidating the funds and having it sit over your bank account for 2 to 3 months. You could qualify off of that. The reason why I mentioned the first one is because you can move a lot faster. This one you have to wait, for the money to season in your bank accounts. You don't want to just have $1,000 in your bank account, and the next month you have 20, and they're like, where the fuck did this come from? So you would just start earlier. You would lose more months, right? In regards to the business credit, you probably lose an additional 2 to sometimes 3 months because you're waiting for it to season there as you're making monthly minimum payments. But you're in a position where you can still use other people's money, and then also allow yourself to figure out, what's the best course of action. But in regards to this, you will lose months, which is not a big of a deal. You can just reconsolidate, like I mentioned previously. But this is the other method if the other one does not work for you in that moment because you don't have the funds on hand. So this is probably the most common one if you're starting from complete zero, but the other one is probably the most practical. You want this to be done for consulting services, because if they try to flag you or they try to say that it's some BS, you can at least prove like, hey, look, I actually provide consulting services over, um, the span of a week for some software, because every single time that you do something in terms of a transaction, they want sources of where the hell that it went, how did it happen, all the above. So when you have source of it, then it's going to make it a lot easier if underwriting ever trips. But I've never had any problems with them tripping. You just want to make sure that you're not saying that you rebuilt this person's house and then they're like, oh, well, where's the proof of that being done? And then you don't have it. It's unless you have guidance doing this, I would not be doing this by myself. Like 100, if this is your first deal, I would not 100% finance it, because you simply just don't have the skill set. You don't understand how to move the finances, and also you're not in a position where you know exactly how to navigate the Section 8 program. So there's possibility you might not have a tenant and you're just digging deeper into a hole. I would only do this if you have guidance. I would 100% finance it with some cash on hand, or just even if you don't have cash on hand, just at least have the guidance to be in a position where you're fine, and then avoid being over leveraged, right? You don't want to be 30K in the hole with the 0% interest business credit with no tenant, and then you're not making any cash back, and then you don't have a job, so it's like now you're 30K in the hole. This is like, doesn't make sense. You want to have your stable active income. You can use this business credit. You find your tenant, you have the right guidance, you'll be fine. This is a method of finance that people do not preach, because one, they either gatekeep it, two, they think that it just doesn't work when in reality it does. The requirements are not that bad. It's like 700 FICO, 4 open accounts, no negative items or high utilization. So don't max out your cards. Don't have a repo. Have multiple credit cards, car loans, student loans. Show proof that you're a reliable person. That also helps you out for qualifying for the DSCR loan. If you want to do this, right, 0% interest business credit, liquidate, put that as down payment. And you want to be just like Alexis, who got his funding. He's running it up. Pablo right here. Section 8 program, you only put like 10K down, and you want your first rental within 90 days guaranteed. Just shoot me a DM with literally just S8, and I'll see if I can help you out. But yes, this is literally a way that you can finance your properties using 0% interest business credit. This is what I've done. I know that it works. I know people that do this all the time. As long as you do it correctly and you avoid getting, not necessarily in trouble, but avoid going through that process where they try to see your manufacturer spending, then you'll be fine. This is something that people do because they understand that the bank understands that they're always going to win. Doesn't matter what the hell it is, because if you borrow that money, you obviously have to pay it back. If you do collections, they're going to get the money back. Like, they literally do not give a fuck. They always know that they're going to win. The bank is always going to win. So don't feel like you're cheating the system, but you are moving a lot faster by either 100% financing your house, 50% financing it, while not negatively impacting your credit score by, like, if you did this with a personal credit. If you did it with a personal credit and you max out those cards, obviously it's going to hurt your credit score and you're going to be in some serious debt. Even if the card is 0% interest, it's still going to hurt you. So if you have any questions about this, just DM me. But like I said, you just get your business credit card by having a good LLC, good personal credit. Be in a position where you liquidate it with the business partner, business person. Make sure that the person is not on the account, on the card, because that will negatively hurt you. If you're trying to send an invoice to someone that is a part of your LLC that you're sending the invoice from, then that's just not going to work, because you might just get flagged by someone like Amex because they think that you're just trying to get cash. And also, if you have an age LLC, it'll make it easier. You don't need an age LLC. But if you don't need funding for your rental and you just want to have it for scaling a business, you can DM me too. I have people that will get you right. But yeah, like I said, just follow those guidelines, do it properly, have the right guidance, and I'll be fine. You'll be making some big moves. I appreciate y'all for watching, and expect more sauce coming through.